October was a big month for dividend raises. We have 88 dividend raises that came through that we're going to take a look at and see what the amount that they raised was, what the new value is after the raise, the payout ratio, see if it's a safe dividend, if it's a good raise, if it's a solid company, and if it's good value. So we're going to get right into this. We do have a whole lot to look at. We're not going to go piece by piece, but we're going to start with what is green. Green is going to be the best stocks here. They have raises above 3%, and they have payout ratios 30 to 60%. So we start with WTTR, Select Water Solutions Incorporated. They rose their dividend from 20 cents per year to 24, which is a 20% raise. Bringing their yield from 2.6 to 3.12, their value from $3.82 to $4.58, and this is the value of the bond yield that we're using here, 5.24%. Really, what these over here are telling you is if you are going to be able to fetch a better return on this investment than through bonds, if you're strictly looking at it for dividend cash flow. Definitely does not look like at the moment that is good, but solid raises, it'd be one to look into, see if they have a history of good raises, and that payout ratio is pretty good. They're really close to that 50%, which is what we like to see. Next is Rockwell Automation Incorporated, ticker ROK, with a 5.93% raise, 28 cents annually, which is pretty good. Going from 1.79% to 1.9%, 40% payout ratio. And this, again, is going to be one where a bond is going to fetch a better return. So you'd be banking on some pretty good capital appreciation if you think that you're going to be beating bonds in today's market with this. Next is Churchill Downs Incorporated. I do want to look into this one. Seems very interesting. Rose their dividend 7% from $1.43 to $1.53 annually, which brought it from a yield of 1.2 to 1.29. Their payout ratio is just towards the lower end of what we like to see, 31%. So they do have quite a bit of growth that they could go with moving forward. But of course, that 1.29% does not come anywhere close to the 5.2 that a bond can fetch you. Next is Sirius XM Holdings, SIRI. This one's come across my radar a few times. I've looked at it, I've considered it, haven't put too much thought into buying it. For one, I don't necessarily like the business concept, but they did raise their dividend 9.92%, going from 10 to 11 cents annually. That is a yield now of 2.15, towards that lower end of the payout ratio we like to see, almost 31%, but definitely not beating bonds. Then we have LKQ Corporation with a 9% raise as well, up to a 2.67 yield, 32.8 payout ratio. Fidelity, FDBC, 5.56 raise, bringing them up to a 33% payout ratio and a 3.1% yield. Zurn LK Water Solutions Corporation, ZWS, 14.29% raise, up to 1.12%, and a 55.14% payout ratio. So they are pushing the higher end of what we like to see there. That is a very large raise that they came in with. So in the future, they could slow those down and probably be fine continuing growth. 14% is pretty large when we see the others are 7-9%. Lincoln Electric Holdings, LECO, almost an 11% raise, up to 1.54%, and a payout ratio of 32.67. Ohio Valley Bank Corp, 46.67% raise, up to 3.91%, 33.67 payout ratio. McDonald's, 9.87% raise, almost 2.5% yield, 58.63% payout ratio. So they are pushing the higher end of that payout ratio we like to see on that dividend. they continue to be very strong at raising their dividend. Even a 5% wouldn't be bad though. So it depends on how much growth they can pull out if they can continue at this pace. Lockheed Martin, LMT, 5% raise up to 2.78% yield, 46.49% payout ratio. That is a very good looking one. Those are the numbers that we really like to see. Not beating bonds for sure, but one of the better current yields that we've seen across all of these so far. RPM International, ticker RPM, 9.52% raise up to 1.91%, 45.3 payout ratio. Thor Industries, THO, a 6.67% raise up to 1.96%, and a payout ratio of 26.26. So they're actually on the lower end with that payout ratio. They could probably be raising that faster, and that's what we'd really want to see from them. Maximus, MMS, a 7.14% raise up to 1.56%, and payout ratio of 42.11. And finally, MSC Industrial Direct Company, MSM, a raise of 5% up to 3.4 yield, and a payout ratio of 53.92. So there were some decent ones there, nothing super incredible. I do want to see who had some of the largest raises to see what's going on with these. So the best of the greens is Ohio Valley Bank Corp. I don't like to deal with banks, so it's not one that I'm going to really be looking into. Select Water Solutions might be something to consider taking a look at. That is a pretty big raise that they came in with. Zurn Water Solutions as well. So it looks like those water companies are coming in pretty strong. And then we do want to look at payout ratios and see who has a risky dividend. Who can we not really count on moving forward? So all of these where it's not reflecting anything, that means that they're probably losing money as is. It's not able to get a PE ratio for them, and definitely do not bank on any of these for dividends going forward. Outside of that, we have quite a few very risky dividends, it looks like. 80 and above is rather high. Definitely does not give them a lot of flexibility if earnings drop, and doesn't give them a lot of ability to reinvest into the business. So these ones are a selection to just proceed with caution. I would not bank on large dividend raises in the future, as you see a lot of them have very small dividend raises, reds and yellows, and there's always the potential that it could be cut. These ones are getting a little high, nothing too crazy. Texas Instruments, I had owned some, I sold out of it. I did a video on why that was, and I definitely do not regret it. It's been down quite a bit since I sold out. It looks like they came in with a moderate dividend raise, not as large as what we'd really like to see, 5% and above, and their payout ratio is creeping above the range that we like to see, up to 66%. So that could be a sign of the business not doing too well. And it's not going to do much better if they're paying out a lot of their earnings to investors in the form of dividend. They don't have enough to reinvest into the company. And then we also have the lower end, things that are below our target range down here. And you see a lot of these are green on their raises. And these are companies who are kind of getting started on their dividends, probably early in their dividend growth journey, and could potentially be something to look at if you want really strong dividend growth. If they can keep up 16% growth year over year, that'd be a very good starting point buying it now. And although it may only be yielding 2.7%, you could have a yield on cost of 5% or so within a few years. In one of the previous dividend raise videos, we've taken a look at why it's more important to look at the dividend growth rate rather than the yield. And we can look at the highest yields and see what's going on here. And I'm sure a lot of these are going to be in the red with the growth and or the payout ratio because they're yield traps. So the blue means that it's a REIT. The REITs are different, and we're not going to worry about those payout ratios because they do their financing or their accounting a little different. They're required to pay out at least 90%. But everything else here, and you see a lot of these are companies who aren't even profitable within the last year. And then others are just very high on their payout ratio, above their actual earnings. So they might have a very high current yield, 6% and above. This section is what would be able to beat a bond, and none of them are sustainable. Potentially some sustainability in Getty Realty Corp, but we would have to dig into that and really see what the growth prospects for the company are. And they came in with a pretty low dividend raise, so I wouldn't be surprised if they're not the best. And that's what we're looking at for this month. So I'll slowly pan over the entire list so you can see if any of the companies that you own came out with a dividend raise, such as AbbVie. I know a lot of people own AbbVie. They have an incredibly high payout ratio. Last year was not good for them, and they came in with a moderate-sized raise. It's a stock that I used to own. I sold out of because I didn't really like what I was seeing with it, and I'm kind of trying to shy away from the pharmaceutical space as well because it's more about the pipeline than it is about the existing business, especially with the expiration of patents. So it's not easy to calculate a fair value and growth projections like other companies. HP Inc. is another one here. I do own some of this. Berkshire Hathaway owns some. They were almost where we want to see on dividend raises. So they only didn't make the cut by 0.01% on their dividend raise. So they could be another decent one. And that's what we're looking at here. ExxonMobil, I used to own some of this. I'm sure a lot of you guys own this. 4.4%, a little low, not bad. Their payout ratio is pretty low. So they do have room to grow it, but they're not growing it. So they might have some better uses for that money. Acquisitions, just general business investment. And I don't see anything else that is a major stock that a lot of people would own. But Visa. Visa down here. Visa came in with a raise of 15.56% and a payout ratio of 25%. So that is probably one where a lot of room to grow it, and they're growing it very fast. So that'd be one where you would likely want to get into it now. And I do have something coming up where I want to look at both Visa and MasterCard and see what the fair values are for those. And at the rate that they're growing their dividend here, there could be some good market beating growth within Visa. So keep an eye out for that one. We're also going to be taking a look at a lot of earnings that are coming out. Vici, Microsoft, Google, Estee Lauder, Eastman Chemical, anything else that you guys would like to see. So I want to thank you guys for watching. Please like if you enjoyed the video, comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.